Hey there, fellow Luck Scouters. Welcome back to another deep dive into the ever-changing world of finance. The economy is throwing us a curveball, and it's more perplexing than ever. It's like trying to read a stock chart in the dark with no flashlight in sight. We're getting mixed signals, folks. It's as if the economy can't make up its mind. One minute things look rosy with positive reports and optimistic forecasts. The next we're bracing for a downturn with alarming headlines and grim predictions. Welcome to the roller coaster that is the U.S. economy in July 2024. It's a wild ride and we're all strapped in. Just this week, we saw some head-scratching news. Unemployment claims went up, catching many by surprise. That's never a good sign. Rising unemployment usually signals trouble ahead, but hold on. The Philly Fed Manufacturing Index surged, showing unexpected strength in the manufacturing sector. That's a sign of strength, right? So, what's the deal? Why the conflicting signals? Is the economy slowing down or revving up? It's a question on everyone's mind. It's enough to make your head spin. The uncertainty can be overwhelming, but don't worry, folks. I'm here to break it down for you. We'll sift through the data and make sense of these mixed signals. We're going to dissect these mixed economic signals piece by piece. We'll figure out what they mean for your money, your investments, and your financial future. And most importantly, I'm going to tell you how to come out ahead no matter what the economy throws at us. We'll explore strategies to safeguard your investments and capitalize on opportunities. So buckle up and let's get started. It's going to be an insightful journey through the twists and turns of the current economic landscape. Let's start with the bad news first. It's never easy to hear, but it's important to stay informed. Unemployment claims jumped to 243,000 this week. That's a significant rise. Just last week the number was 223,000. This week's increase is quite alarming. Not the direction we want to see, folks. This kind of spike can have ripple effects throughout the economy. This spike in unemployment claims has everyone on edge. People are understandably worried about what this means for their future. Why should we care about unemployment claims? It's a key indicator of economic health. Well, it's simple. When more people are filing for unemployment, it means businesses are laying off workers. Layoffs can lead to reduced consumer spending, and that's a big red flag for the economy. It signals potential trouble ahead. It tells us that businesses might be worried about the future. They could be anticipating lower revenues. They might be seeing a slowdown in demand. When demand drops, businesses often cut back on production and staffing, and that could spell trouble for economic growth. A slowdown in one sector can affect others, creating a domino effect. Now I know what you're thinking. 1 week of data doesn't make a trend, and you're right. But this increase in unemployment claims is something we need to keep a close eye on. It could be an early warning sign. If it continues, it could be a sign of a weakening labor market. A weak labor market can lead to lower wages and reduced job security, and that would be bad news for all of us. It's crucial to monitor these trends and understand their potential impact on our lives and the broader economy. On the flip side, it's also a call to action. Communities and policymakers can work together to support job creation and economic stability. By staying informed and proactive, we can navigate these challenges and strive for a more resilient economy. Okay, so the unemployment news wasn't great. It's understandable to feel a bit down when you hear about job losses and economic downturns. But let's not dwell on the negatives for too long. But before you hit the panic button, let's talk about the good news. There's always a silver lining if you look closely enough. The Philly Fed Manufacturing Index just surged to 13.9. This is a significant leap, especially considering the economic climate we've been navigating. That's up from a measly 1.3 the previous month. Such a dramatic increase is not just a number, it's a beacon of hope. Now that's what I call a comeback. It's like watching your favorite team score a winning goal in the final minutes of the game. For those of you who don't speak economist, the Philly Fed Manufacturing Index is a big deal. It's one of the key indicators economists use to gauge the health of the manufacturing sector. It's a measure of manufacturing activity in the Philadelphia region. This region is a significant hub for manufacturing, so its performance can reflect broader economic trends. And a reading above zero means the manufacturing sector is growing. It's a clear sign that things are moving in the right direction. So a jump to 13.9 is a sign that factories are humming, orders are pouring in, and production lines are busy. And that's good news for the economy. When factories are busy, it means more jobs, more income, and more economic activity. This surge in manufacturing activity is a welcome bright spot in an otherwise uncertain economic landscape. It's a reminder that, even in tough times, there are areas of growth and opportunity. It suggests that businesses are still investing and growing. Companies are not just surviving, they're planning for the future. And that's a positive sign for future economic growth. It's a signal that we can look forward to better days ahead, with more stability and prosperity on the horizon. So, here's the million-dollar question. What do these mixed signals mean for the economy? Well, folks, it's a tug of war. On one side, we have the concerning rise in unemployment claims. That's pulling the economy down. On the other side, we have the booming manufacturing sector. That's trying to pull the economy up. Right now, it's too early to say which side will win. The economy is like a bucking bronco. It's hard to predict which way it's going to go next. We need more data. We need to see if these trends continue in the coming weeks and months. But here's the thing. Even with these mixed signals, there's no need to panic. The U.S. economy is resilient. It's been through tough times before, and it always comes out stronger on the other side. Now let's talk about what really matters, your money. These mixed economic signals have investors scratching their heads. Should you buy? Should you sell? Should you just bury your money in the backyard and hope for the best? Relax, folks. I'm not going to let you resort to burying your hard-earned cash. Here's the deal. The stock market hates uncertainty, and right now, that's all we've got. So we can expect some volatility in the coming weeks. The market might go up one day and down the next. Don't let it rattle you. The key is to stay calm and stick to your investment plan. Don't make any rash decisions based on short-term market movements. Remember, we're in this for the long haul. In times of economic uncertainty, it's always a good idea to play a little defense. That means protecting your portfolio from potential losses. Think of it like putting on a helmet before you ride a bike. So, how do you play defense in the stock market? One way is to focus on defensive stocks. These are stocks of companies that tend to do well even when the economy is struggling. Think consumer staples. People still need to eat, drink, and brush their teeth even during a recession. Another defensive strategy is to increase your cash position. Having some cash on hand gives you flexibility. It allows you to buy stocks if the market dips. And it gives you peace of mind knowing you have a cushion if things get really rough. Bonds are like the boring but reliable friend of the investment world. They might not be as exciting as stocks, but they can offer stability and income, especially when the economy is uncertain. Think of bonds as your safe haven. When the stock market is going haywire, bonds can provide some much-needed stability to your portfolio. They are less volatile than stocks, and they can provide a steady stream of income. Now, I'm not saying you should dump all your stocks and buy bonds, but adding some bonds to your portfolio can help you weather the storm if the economy heads south. Remember that surge in the Philly Fed Manufacturing Index? Well, that's creating some exciting opportunities for investors. If the manufacturing sector continues to grow, certain stocks could really take off. I'm talking about industrial stocks, folks. These are companies that make the machinery, equipment, and materials that factories use. Think steel, machinery, and transportation companies. Now, I'm not saying you should go out and buy every industrial stock you can find. You need to do your research. Look for companies with strong earnings, solid balance sheets, and a history of growth. Don't put all your eggs in one basket. Here's a golden rule of investing that never goes out of style: diversification. Don't put all your eggs in one basket, folks. That means spreading your investments across different asset classes, sectors, and geographies. Why is diversification so important? Because it helps reduce risk. If one investment goes south, you won't lose everything. You'll have other investments to cushion the blow. So, how do you diversify your portfolio? It's simpler than you might think. Invest in a mix of stocks, bonds, and maybe even some real estate or commodities. Within each asset class, diversify further. Don't just invest in one or two companies. Spread your bets. The economy is sending us mixed signals. Unemployment is up, manufacturing is booming. It's enough to make even the most seasoned investor feel a little seasick. But here's the good news. You don't need a crystal ball to navigate these choppy economic waters. Just remember these key takeaways. Stay informed. Keep an eye on economic indicators, but don't overreact to every blip in the data. Play defense. Protect your portfolio with defensive stocks, bonds, and cash. Look for opportunities. The manufacturing boom could create some exciting investment opportunities. Diversify. Don't put all your eggs in one basket. Spread your risk. Listen, I know it's easy to get caught up in the doom and gloom. The financial news can be a real downer sometimes, but here's the thing. The American economy is a powerhouse. It's weathered countless storms before, and it always comes out stronger on the other side. So don't panic. Stay calm. Stick to your investment plan, and remember, the best way to predict the future is to create it. Happy investing. Please like the video and share it with others. Thank you for watching.